Welcome back to Boni's Life, where we explore the fascinating intersections between science, technology, and the financial world that shapes our daily lives. I'm Boni, and today we're diving deep into one of the universe's greatest mysteries, dark matter, and discovering how its invisible influence mirrors the hidden forces that drive our financial markets. When I first started studying quantum physics and its applications to finance, I thought I was just being overly ambitious. But as we'll see today, the same principles that govern the invisible 85% of our universe's matter also help us understand the hidden patterns in market behavior. It's like discovering that the force keeping galaxies together operates on the same principles as the invisible hand of the market, except this hand might actually be quantum mechanical. Let's start with the basics because understanding dark matter is crucial to grasping how invisible forces shape reality, both cosmic and financial. According to NASA's latest research, everything we can observe in the universe, from people to planets to entire galaxies, represents less than 5% of what's actually out there. Dark matter makes up about 27% of the cosmos, while dark energy accounts for the remaining 68%. Now here's where it gets interesting for us as traders and investors. Dark matter doesn't reflect, absorb, or radiate light, at least not enough for us to detect directly. Sound familiar? It should, because this is exactly how many market forces operate. We can't see them directly, but we can observe their effects on price movements, volatility patterns, and market structure. The story of dark matter's discovery reads like a financial thriller. In the 1930s, Swiss astronomer Fritz Zwicky was studying the Coma galaxy cluster. Imagine it as a cosmic portfolio of over 1,000 galaxies. He noticed something peculiar. These galaxies were moving faster than they should have been based on the visible matter he could observe. It was as if there was some invisible force providing additional gravitational pull. This reminds me of what Dr. Kwangwon An from Yonsei University recently discovered in his groundbreaking study published in Financial Innovation. He found that stock return patterns follow quantum mechanical principles, where stock return drift results from an external potential representing market forces, pulling short-term fluctuations back to long-term equilibrium. Just like Zwicky's galaxies, our markets are influenced by forces we can't directly observe but can certainly measure. This is where our story gets really exciting. Dr. Daniel Sungyeon Kim from Chungang University, who co-authored that study with Dr. An, put it perfectly. Our study shows that quantum mechanics can be a useful tool to understand the stock market, which is a complex system with many interacting agents. Think about it. Both dark matter and market forces operate through what physicists call non-local effects. In quantum mechanics, particles can be entangled across vast distances, instantly affecting each other's behavior. Similarly, a policy announcement in Washington can instantly affect currency markets in Tokyo, or a tweet from a tech CEO can ripple through global equity markets in milliseconds. The researchers used the Schrödinger equation, yes, the same equation that describes quantum particles, to model stock market fluctuations. They introduced what they call a diffusion coefficient to capture stock return volatility, and the results were remarkable. The model produced what's known as a power law distribution in market tails, which explains why extreme events like market crashes are more likely than traditional models predict. Now, I know what some of you are thinking. Boni, this sounds like academic theory. How does this help me make better trading decisions? Well, here's the practical application. The power law exponent they discovered is inversely related to market volatility and the speed of mean reversion. In simple terms, higher volatility and slower returns to equilibrium lead to stronger herding behavior among investors. The financial industry's biggest institutions aren't just paying attention to these quantum finance connections, they're investing heavily in them. IBM's Institute for Business Value recently published a comprehensive report on quantum computing applications in financial services, and their findings are game-changing. According to IBM's research, financial institutions that adopt quantum early can seize major competitive advantages, including the potential to leapfrog competitors to become market leaders. They've identified three main categories where quantum computing will revolutionize finance: targeting and prediction, trading optimization, and risk profiling. But here's what really caught my attention. IBM notes that quantum computing's advantage comes from its solution space being orders of magnitude larger than traditional computers. While doubling the power of a classical computer requires roughly double the number of transistors, a quantum computer's power can be approximately doubled by adding just one qubit. This exponential scaling is remarkably similar to how dark matter's gravitational effects scale across cosmic distances. Just as dark matter forms a vast web-like structure that influences galaxy formation across billions of light years, quantum computing creates solution spaces that can process market complexities traditional computers simply cannot handle. Financial regulators worldwide are taking notice. The Bank for International Settlements recently published a paper titled Quantum Computing and the Financial System: Opportunities and Risks, highlighting both the transformative potential and the challenges ahead. The regulatory concern isn't just about competitive advantages, it's about systemic risk. When quantum computers become powerful enough to break current encryption methods, the entire financial system's security infrastructure will need to be rebuilt. Banks and financial institutions are already transitioning to quantum-resistant cryptographic algorithms, a process that the banking industry describes as urgent. This regulatory preparation mirrors how astronomers had to develop new detection methods for dark matter. Just as we needed gravitational lensing and galaxy rotation studies to see dark matter's effects, financial regulators are developing new frameworks to monitor and manage quantum-enabled market activities. So what does all this mean for traders and investors? Let's break down the practical implications, because understanding these invisible forces can give you a significant edge in today's markets. First, volatility clustering. Those periods when high volatility tends to be followed by more high volatility can be better understood through quantum mechanical models. The research shows that economic uncertainty acts as an intermediary linking business cycles to herding behavior in stock returns. During uncertain times, investors exhibit stronger quantum-like entanglement in their decision-making. Second, the power law distributions we discussed earlier have direct implications for risk management. Traditional models using normal distributions consistently underestimate the probability of extreme market events. Quantum-inspired models, however, account for the fat tails that characterize real market behavior. Goldman Sachs has already partnered with AWS to explore quantum computing applications, while HSBC is working with IBM on quantum technologies. These aren't just research projects, they're preparing for a fundamental shift in how markets operate. Here's where the dark matter analogy becomes particularly powerful. Just as dark matter provides the gravitational scaffolding that holds galaxies together, there are invisible market structures that provide liquidity and stability to financial markets. Dark pools, private exchanges where large institutional trades occur away from public markets, represent roughly 15 to 20% of all equity trading volume. Like dark matter, these trading venues are invisible to most market participants but have enormous influence on price discovery and market structure. High-frequency trading algorithms operating at microsecond speeds create another layer of invisible market influence. These algorithms can detect and respond to market patterns faster than human perception, much like how dark matter's gravitational effects operate on timescales and distances beyond our direct observation. The fascinating parallel is that both dark matter and these hidden market forces follow quantum mechanical principles. Dark matter particles are thought to interact primarily through gravity and possibly the weak nuclear force, while algorithmic trading systems interact through information asymmetries and speed advantages that create quantum-like entanglement effects across global markets. Dr. An and Dr. Kim's research revealed something profound about economic uncertainty's role in market behavior. They found that uncertainty acts as a quantum field, influencing how market participants make decisions and how prices evolve over time. During periods of high economic uncertainty, think 2008 financial crisis, COVID-19 pandemic, or geopolitical tensions, markets exhibit stronger quantum-like properties. Price movements become more correlated across seemingly unrelated assets, volatility clustering intensifies, and traditional diversification strategies break down. This is remarkably similar to how dark matter behaves under different cosmic conditions. In regions of high dark matter density, its gravitational effects become more pronounced, influencing the formation and evolution of cosmic structures. Similarly, in periods of high market uncertainty, the invisible forces of sentiment, fear, and greed become more powerful drivers of price action. Looking ahead, the convergence of quantum computing and financial markets promises to revolutionize how we understand and participate in global finance. IBM's research suggests that within 3 to 5 years, quantum computing will produce breakthrough products for specific financial problems. McKinsey and Company estimates that quantum computing use cases in finance could create $622 billion in value by 2035. This value creation will come from improving existing processes like portfolio optimization, risk assessment, and fraud detection, while also enabling entirely new approaches to market analysis and trading strategies. The quantum advantage in finance mirrors dark matter's role in cosmic evolution. Just as dark matter provided the gravitational framework that allowed normal matter to form stars, galaxies, and ultimately life itself, quantum computing will provide the computational framework for the next evolution of financial markets. Let me bring this back to practical applications for your investment strategy. Understanding these quantum dark matter principles can improve your market analysis in several concrete ways. First, recognize that market correlations aren't static. They're dynamic and can change rapidly during stress periods, much like how dark matter's influence varies across different cosmic environments. Diversification strategies need to account for these quantum-like correlation shifts. Second, volatility forecasting becomes more accurate when you incorporate quantum mechanical models that account for uncertainty as a fundamental market force rather than just a measurement problem. This can help with options pricing, risk management, and timing strategies. Third, understand that extreme market events, those black swan moments, are more probable than traditional models suggest. The power law distributions we discussed earlier should inform your position sizing and risk management approaches. As we wrap up today's exploration, I want you to consider this profound connection. Adam Smith's invisible hand of the market might actually be a quantum field, operating according to principles we're only beginning to understand. Just as dark matter shapes the large-scale structure of the universe while remaining invisible to direct observation, the quantum forces in financial markets shape price movements, volatility patterns, and market cycles through mechanisms that traditional economic theory struggles to explain. The researchers, institutions, and regulators we've discussed today are all working toward the same goal: understanding and harnessing these invisible forces to create more efficient, stable, and profitable market systems. Whether you're a day trader, long-term investor, or financial professional, recognizing these quantum dark matter principles can give you a significant advantage. The universe is far stranger and more interconnected than our everyday experience suggests. Dark matter, quantum mechanics, and financial markets all operate according to principles that challenge our intuitive understanding of reality. But as we've seen today, these seemingly abstract concepts have very practical implications for how we understand and navigate financial markets. The next time you see an unexplained market movement, a sudden volatility spike, or a correlation breakdown that doesn't make sense according to traditional analysis, remember that you might be observing the financial equivalent of dark matter, invisible forces that shape market reality in ways we're only beginning to understand. The future belongs to those who can see the invisible, understand the quantum, and navigate the dark matter of financial markets. As quantum computing continues to evolve and our understanding of these hidden forces deepens, the opportunities for those prepared to embrace this new paradigm will be extraordinary. Thank you for joining me on this journey through the invisible universe of dark matter and quantum finance. If you found this exploration valuable, please like this video, subscribe to Boni's Life for more cutting-edge analysis, and let me know in the comments what other cosmic financial connections you'd like us to explore. Remember, in a universe where 95% of reality is invisible, the key to success is learning to see what others cannot. Until next time, keep exploring the invisible forces that shape our world.